Investing insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Hey there, everybody. Steve Waters and Victor Kumar back again. And it's been a while, Vic. 5 months.
5 months, yeah.
For another live recording and filmed of our awesome podcast, Investing Insights with Right Property Group. And clearly the reason we haven't got together in the last 5 or there months is because we've been in the harsh lockdown, as everybody would know. So we're not going to even bother talking about that today because I think we're all a bit fatigued with lockdown, the talk of lockdown, the narrative around COVID. We're just over it.
Yeah, pretty much. Everyone wants to move on. But there is obviously a very strong tilt towards the media saying that, maybe the property market's coming to a peak, or maybe next year is going to slow down. We've got APRA coming in with their supposed attack on slowdown, if I can use that word. But there's a lot of moving pieces, and I thought that we would just talk property today.
Well, I hope so. 'Cause if you want to talk about any other subject, I need a bit of warning.
Yeah, just for the listeners, Steve and I have struggled for the last 5 minutes saying, okay, what are we going to really talk about?
And to be fair though, it's not because we don't give it any thought or bandwidth. It's just that because we talk about this every day, and a lot of the subjects are quite repetitive, but with a different slant on it. We've always just winged it or wung it. Winged it. We've always just winged it. And we thought today that, look, we were going to do that, but there is something that we thought was prudent of us to be able to talk about today, and that is investing between the flags. And we'll explain that a little bit later on. But before we do, Vic, what's been happening for 5 months?
For 5 months? Well,
because sorry to interrupt, this is about only the third time we've
met this year. Physically, face to face. Yeah, we've been meeting on Zoom pretty much every day, and on Facebook Live. So every second Thursday evening. So if you haven't, come across our Facebook Live, just go to our Facebook page. There's all those historical Facebook Lives there. A lot of gold in there as we talked about the topical things, and then true to form, we always went off on tangents. Meeting face to face today, I think the biggest thing was that the cafe owner where we go to have our breakfast before we come here to do our podcast remembered us even after 5 months. Right,
it's good service, good hospitality,
good
business.
Yeah, absolutely.
It's and I think they're all amped up.
That's right.
To actually be out and about and perpetuate their businesses.
Yeah, but you could see that these businesses, as the volume ramps up, they're struggling to keep up because they've started from a stop, and like most businesses and like most people that are investing, when you go into a lockdown, you tend to overthink things a bit because all of the stimulus, external stimulus, is either accentuated or diminished depending on how you've handled lockdown.
Well, that actually brings me to the subject that we just brainstormed. Investing between the flags, because as you rightly said, people tend to overthink a lot of stuff. It's just the ability that we all have, be it negative or positive, and when we're in a lockdown and when we're isolated, the cogs seem to spin a lot quicker. But the fundamentals, even though we've all heard that word a million times, always ring true, always stay there. It's just that now with COVID, as we've mentioned before, there's a few fundamentals that have changed.
Yeah, exactly.
And will continue to change. And we also wanted to talk about data. Now, I know people just probably rolled their eyes and said, okay, here's another podcast about data. But we want to talk about it a little differently and not in a positive sense. Essentially.
So we're talking about the dirty 4-letter word in property then, data.
Data.
Yeah.
I thought you were going to say commitment, but there's a few more letters than 4. It's so whilst we consume data like oxygen every single day and it's necessary, there's also a great deal of data that is incorrect.
That's right.
At that point in time. And when you look at data in isolation, that's where the danger can occur. Now, I know that probably people out there saying, well, that's all I do. You are wrong, Steve and Vic. Data never lies. Well, then you haven't seen enough of it.
Yeah, exactly.
And so 2 things, investing between the flags and data. But coming back to the first one, which is investing between the flags, what we're really saying there is within your means.
Yeah.
Not even for the now, but for the tomorrow and the day after.
Don't get swayed by the newfound confidence or seeing other people swimming outside the flags, and you've just started swimming, or you're not such a strong swimmer. In other words, your financials aren't as robust, and you're trying to emulate them. Run and chase your own opportunities and wins, not someone else's.
Well, just like the surf conditions, they change.
Yep.
So too does your life. And there's probably enough of the analogies and cliches, but it rings true, because we've just probably at the end of a very purple patch.
Correct.
In terms of real estate. And so what happens is, and we see this now, maybe a dozen cycles, what happens is people get caught up in the now and forget about normality. And normality may be the market.
Yep.
In normal senses, might be their life, their wage structure, the performance of their property or properties, whatever it may be. And just inherently the risk profile increases, and a little bit of speculation starts to creep in, because, well, what's the worst case scenario? Everything's heading north. If I speculate, worst case scenario is I break even. Best case scenario is I get a multiplier effect. And it's never right to do it that way. However, it's even more dangerous as you get to the end of a cycle. But let me be clear, when I say the end of a cycle, I'm being very general, because there'll be still markets that will perform very well. There'll be markets that give a little bit back, and there'll be markets that go sideways. It doesn't mean that it's the end of the growth pattern or growth cycle. It just might mean that the elevated growth days are gone.
That's right. The growth acceleration is starting to slow down. And I guess one of the dangers of, getting or jumping into investing off the back of the bull run like this is that a few wins and you think that you've got this down pat, and that's when you start cutting corners, because you've got all that equity parked away. You've got the ability to borrow money rather easily in today's climate, and you feel that you are just you just can't fail, and that's where failure comes in from.
Yeah, because you forget the step-by-step process of mitigation.
Yep.
And we'll talk about that. Maybe we'll give some tips at the end of the podcast around, well, here are things that we do and we encourage our clients to do, which has no downside. Yeah, potentially.
Yeah. Well, if you look at the airline industry, it's back up and running. So if you take an analogy from there, a pilot, regardless of how many times he's taken off, still goes to the same routine check every single time. Even if it's just landed half an hour ago, he does the same routine checks before he takes off. It's the same with investing as well. Regardless of how many times you've purchased or how many people you've seen purchase and become successful, you still need to do your due diligence and the checks.
It's a good analogy with the pilot, because if he shortcuts the process, the consequences are diabolical.
Yep.
And
very hard to recover from it.
Well, yeah. And look, not saying that death and property investing is on the same page, but there's a certain amount of importance and self-regulation that you need to encompass and encourage yourselves to do. And we'll talk about that a little bit later on. But investing between the flags is not also just about saying safe. It's not about putting the rubber blow-up things on your arms and sort of going knee deep. It's just about...
I can almost see you doing that in the beach.
I probably did do it. It's more about saying, well, here's my lane.
Yep.
This lane works. This lane is safer than outside the flags. But there's still things we need to do to be able to mitigate the risk within the flag. So let's talk about that. And the first one is always cash flow. Now,
I don't know how many times we've said that.
I know. As I just said that, I thought, here we go again. We're talking about cash flow again. But it's very easy to forget about cash flow in a boom market.
Yep.
Because people tend to forget about the cash flow when there's amplified growth patterns there. Makes them feel warm and fuzzy between their ears, and there's almost a justification about the lack of cash flow management that makes them feel good. But as I've mentioned in the past, when the growth stops and the cash flow is horrendous, you pivot to become a resentful investor.
Yeah.
But so too does everybody else, and that's the beginnings of a downward trend in market, along with other sort of characteristics. So making sure that you're balancing all the time is for me, such an important point. But people tend to let go of that during the boom times. It's like, I just want to buy. And there's probably a fair amount of credibility to that, but you actually can do both.
Balancing happens all throughout.
Yeah, all the time. And that's why we do the reviews.
Yep.
Some of the other things, though, that in terms of diversification, which in itself is a form of mitigation. So we've talked about cash flow management. We're not talking about positive cash flow properties or commercial, whatever it is to you. Yep. It is, but it's more about the cash flow management, including yourselves.
In other words, the affordability factor back to you.
To you, but not today, tomorrow.
Yep.
Once again. Diversification around property type, potentially.
The areas,
the state, the suburb, the street, the LGA, whatever it is to you. And the reason I say that is very rarely do you have this instance where all markets are heading north.
Yes.
Usually, some are going up, some are going sideways, and there might even be a few that give back a little bit, which happens to all markets at a point in time. But when you're well spread, well versed throughout these different localities, hopefully with some growth-orientated properties, hopefully with some cash flow-orientated properties so that we're balancing that bottom number, well, then you're quite sheltered from the large swings and roundabouts that markets will give you, whether you like it or not. Yeah.
So when you look at these types of portfolios that we're putting together, obviously there's the foundational properties, which has got, the diversification, the cash flow management and all that. Then as the portfolio matures, then we're starting to perhaps try the hard up surfing areas, right? Because we've now got a rock solid foundation. So we can actually go a little bit outside of the lane with good risk mitigation in place.
So what would those pieces of risk mitigation be to you?
So first of all would be, the availability of capital and cash reserves to begin with, and having the experience to say, look, if it goes against me, this is my escape, this is my get out of jail card for this property, and how, this is what the impact will be on the portfolio. So a good example of it would be, say, perhaps buying that holiday home, right? And looking at Airbnb. Steve, you're smiling because we talked about it just about half an hour ago, right?
Yeah, literally. Yeah.
It's for most people it's a dream, right? And they justify it by putting a coating on it to say, well, we'll Airbnb it when we're not using it. The reality is that when you want to use it, most people want to use it around that time anyway. And secondly, fairly strong changes happening with the short-term rental market with the legislation, right? So there's all of these risks that you need to take into account to say, okay, this is my best case scenario, but if only the worst case scenario could happen with this property, can I survive? Does it hold me back? Does it put me back 2, 3, 5 years? Or can I still have this as a thorn in my side? And we've got a few now in our portfolio. Can we still have this as a thorn in my side and still continue building my portfolio towards my end goal? So this is where it's really important not to take your eyes off your end goal just because you're just outside the flags.
Well, let's talk about that then, the end goals. And I'm adamant that people's original goals,
they change.
They're different.
Especially after COVID, they're much different.
Yeah, but even within years of the journey, so to speak, of investing. So the most tangible thing, as we spoke about before, is that replacement of current income. That's a tangible goal.
Yep.
And let's just say that it was 40 years out there. That's the horizon goal. But even within 5 years, the goal will change, or the circumstances will change, and it may not be the goal. You've had a set of triplets, and now it wants to be a larger principal place of residence, or you might want to take a sabbatical and become a monk.
Yep.
Whatever it may be.
Yep. Nothing wrong with that.
Nothing wrong with that. But things will change, and so it's important that as your goals change, your circumstances change, but always protect the bottom line and have the ability to be able to slightly pivot in terms of the strategy. And you can't do that if you're too tilted one way or the other in terms of growth, even potentially cash flow, dare I say.
Yeah, that's true. And it's important as you pivot that you don't undo the hard work you've already done, so that you're not putting everything at risk. So there needs to be a set and forget. I'm protecting this bunch of properties or property, and I'm going to do this. And if this fails, it does not significantly impact what I've already got. That's really important to look at it that way.
And so if we're talking coming back to risk mitigation, because we're staying within the flags, and once again, that's within our own sort of parameters and capacities. What else would you suggest to people so that you're in a position to be able to go forward? Because you don't want to just tread water, lay around and do nothing and watch opportunity sort of drift away. What else would you suggest to contain the mitigation or retain mitigation, but still be able to move forward?
Well, first off, you need to know your exact numbers in terms of what your current portfolio is costing you, or if you haven't got a portfolio, frankly, you shouldn't be swimming outside the flags if you haven't got a portfolio, but let's say you did. You need to know your position in terms of, if things went against you, how long can you sustain the cash flow on the property that you're acquiring, and whether you truly can undertake the full strategy on the property. So as an example, let's say it's a property with a simple subdivision splitting into 2 titles, right? But you haven't got the funds. You've got the funds to acquire the property, but you haven't got the funds to go on and then split the property into 2 in, say, a year's time or 2 years' time, right? Because not only are all your savings dried up, you're now totally dependent on the upward trajectory of that property, and neither you nor I nor anyone can control the market.
Right? Or the future.
Yeah. So that's something that if it goes your way, that's really good. Yes, we can, and we'll come back to data on that. We can look at it and speculate safely that it'll go up or down or sideways. But we need to also look at, okay, if we haven't got the money, and let's say we're having a change in the family scenario, so kids, or we're having a change in the employment situation where we're going from PAYG to, say, perhaps contracting or self-employed, there goes your lending for at least a year, 2 years. And in the meantime, you've taken on a property that's actually, say, costing you, as an example, $500 a month to hold, right? I'm being very generous over here, because most people, when they get subdivision type properties, they're spending a lot more to hold these types of properties. So you need to look at it in the sense that nothing goes your way. Are you still able to hold onto this property for the next finance cycle to come across, for you to be able to offload this, or to be able to actually finance this from within its own equity for the subdivision itself?
You raise a good point there, and you mentioned finance cycle, because there's really 3 cycles.
Yes.
And if everybody pictures the property clock, which we've all seen potentially hundreds of, and side note, never really that accurate, there is the market cycle or the property cycle. Then you should be overlaying the media property
cycle.
clock over the top of that, and then somewhere at the top or the bottom is the finance cycle. And what I'm referring to there is the availability of credit. The cost of credit is clearly very, very important, or the cost of money is very, very important, but probably more so the availability of it is more precious, because that's what makes the market move, is the availability of credit. I mean, just go back to
2019.
Well, prior to that, 16 with APRA. And the handbrakers we've talked about many times, and it's been throughout the media, and how that just essentially stopped people getting into the market. The intent was there, but the ability wasn't. Fast forward, a lot of what we're seeing today is a repercussion of that in some way, shape or form.
Because it's all that pent-up demand, right?
Correct.
That's been released.
Correct. And the lack of supply
Yep.
in a lot of areas, because investors weren't providing accommodation. If you bring that forward to today in terms of the finance cycle, because that's what we're heading into now. The intent is there still. The elevated want, or the elevated intent to purchase property will always be there. It's just, well, how can I get my hands on finance? How can I get my hands on credit? And then what is the cost of money? And so when we take into account that clearly, unless you've been hiding or living under a rock, the media is full of negativity at the moment around finance. We had the APRA sort of touch.
Tap the brakes,
what, a month, maybe 2 months ago now, or thereabouts. And now in the media, in mainstream media and social media, that we're just seeing, well, inflation is going to go through the roof. It's going to explode, and rates are going to explode. In fact, I saw a headline this morning saying this is the beginning of the end for all you investors. That was the headline. It was like, well, okay.
Headlines sell.
Well, they do. Clickbait. It's clearly. But let's flesh that out. what happens if rates go up? What happens if they go up by 0.5%?
Mm-hmm.
What's the immediate effect? Already we can see that the market is starting to react to the media, and maybe it's all deliberate.
Yeah.
There's a conspiracy in me. In combination with what APRA's done, that people at the top of the market more so are trying to now take the price. So I, as an individual, deem this the top of the market, so I'm going to sell my property now. But so too is the collective. And so there's definitely more stock on market at the top end.
And it's a bit of a herd mentality as well, right? So one person
Always
jumps
is.
and then everyone starts jumping in.
Yeah, once you get that that herd mentality, that's where it could potentially become a self-fulfilling prophecy. But I did mention the top of the market and probably the middle, the affordable corridors. Still very little stock on market, and that's throughout Australia. And some markets are growing at a higher rate than others at the moment. Like I read the CoreLogic report the other day. Sydney's now come off its peak in terms of the rate of growth. So let me say it again, the rate of growth.
So in other words, there'll still be growth.
Correct.
Yep.
Brisbane has accelerated. Melbourne has come off slightly. In fact, everything else has come off slightly, except South Australia and Brisbane, I believe. And will probably do so. Now, is that a repercussion of the media and APRA? Maybe, maybe not. But it's probably more if you back the truck up. It's probably more the seed was planted maybe midway this year for those areas, and even beforehand for those that look for the trends that then become data, et cetera, et cetera. So making sure that if I come back to the investing between the flags, making sure that we are always in control of the cash flow, have the money before you need it, then you're always well within your means. But it also gives you the ability to execute opportunity when it presents itself.
That's right. That's right. And knowing that there are resources to help you get out of trouble, right? In other words, your lifeguard in this scenario, but in the investing scenario, it is actually your constant portfolio reviews. It is the cash flow management. It's also making available the equity that you have got, in liquefying the equity so that when finance does slow down, when you're unable to tap into equity, you've already done that. You've already got that parked aside. And that's where potentially you are able to then swim just outside the flags with the opportunities, right? Because investing's not about chasing markets. Investing's about chasing opportunities within the markets. So whether it's an up, down, sideways market, there are always opportunities depending on where your portfolio is, how well prepared you are, and how experienced you are.
So let me just repeat that, because that's a good point. Investing is not about chasing the market. It's about identifying the opportunity, controlling the opportunity for tomorrow's market.
That's right.
That's what real estate is about. Every now and again, we're in a situation where we can make immediate gain. Very unusual, to be fair, and I'm being very blunt and frank here.
With our investing, we've probably seen this scenario perhaps 2, maybe 3 times.
Correct.
Yeah.
But we've also seen probably a dozen different crises.
Correct.
Throughout the years, and like we can't escape or disguise the fact that this market is beyond and above anyone's expectations. In fact, as I say that, I remember probably 3 or 4 years ago now, I said, I wrote a blog or something along the lines of tomorrow's best performing markets have been stagnant for the last 5 years. And that's because the dynamics were cooking.
Yeah.
But it was more around the availability of credit.
And that's a brilliant segue into data.
Correct.
Right? Because when you look at it, most people say that this area hasn't grown for 5 years, this area hasn't grown for 10 years, or it's gone backwards for the last 2 years. That's just interpreting the data. You need to get to the ground truth, see what's actually happening in that area, to then marry that up with the data to say, okay, yes, the current data is telling me this, but the trend on the ground and the pieces moving on the ground are showing a path this way. And when I log that, and when I marry that up against the data that I've got on hand, it shows me what type of property I need to buy there, or whether not to buy there, or to go heavy into that area. Because like we keep saying, it's cyclical in nature. So long as all the fundamentals are addressed, so we're not in a area where there is just one employment type, and if that sector dies down, that's it. The area is done. So we don't want to be investing there. So it still needs to have all of those fundamentals, but then we need to marry the data with what's happening on the ground, and not speculate to say, okay, if it hasn't moved for 10 years, so why will it move?
Yeah, because it's actually a very good point. So if we talk about data, which does actually roll into investing between the flags. Data comes in many different shapes and forms. Essentially what we're saying is that don't always believe the data. And whilst it's very, very important, find out the relevance behind the data, the trend behind the data. So let's talk about the different types of data. It's not just about price growth. It's not just about stock on market,
days on market.
They're all important points. Don't get me wrong. Or population growth, jobs numbers, et cetera, et cetera, et cetera. There's probably not one piece of data that you could solely use.
Yeah,
it is literally a jigsaw puzzle of all these different types of data to paint a picture, to give us the outline of a picture. Often, which the data that we're digesting is months, years old.
Yeah,
sometimes. So we're actually looking for as we mentioned in one of our lives a couple of months ago, we're actually looking for the trends before the data, sustainable trends
before the data catches it,
that become data.
Yeah,
and then the herd mentality follows in. But let me repeat that just so all the people out there that are data junkies, as we are, don't misinterpret what I'm saying. Data is extremely important, very, 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 very important. There's not one piece of data, there's multiple pieces of data that we need to collate, but we want to know what the ground truth is.
Exactly. So you can't just look at the data in isolation.
Correct. So let's give some negatives in terms of just data. And the first one that comes to mind is when you see the median or the average price of an area, which I see on a weekly basis. People say, I bought below the average, I bought below the median, which means nothing. So do you want to explain that?
So if you look at it, and this is perhaps one of the catch calls of property investing, right? Median price in this area has jumped by 20% in the last 3 months. So if you look at how median is, it's lining up all of the sales in a line, and you're picking the middle. So not the average, the middle, right? So if the cluster of sales has been traditionally in the, say, 500,000, and there's a new development that's happened, and now they're selling for 600,000, and so traditionally there's only 20 properties selling for 500, and that's still the case. 20 are selling for 500, but in that quarter, this development's been released, and the sales have settled, and let's say they were selling for 600. There's a big movement in median price where, so let's say 30 of them or 40 of them sold for 600. The median's shifting from 500 to, say, 550, 600. It'll actually it'll shift to the 600 because there's more of the 600s when you're laying it in a straight line. So more than likely you'll pick that up as the middle, and that media then catches up onto that and says median prices have jumped from 500 to 600 in the suburb. But the actual ground truth is that, okay, there's a development that is released. Once that development goes away, yes, of course, it set up the new price trend in that area, but that was purely because of development. So there's no other fundamentals that was pushing the prices up.
There'll be no new sales, so the actual median will drop.
Yep.
So the people out there that are going, well, that's just not physically possible, or that's in isolation. Let me give you a real example. We would have to go back to last cycle, maybe the cycle before that, for relevance, where, and I've mentioned it before, that there was a suburb up on the north coast, I'll call it, of New South Wales, that had, I remember the media now, the highest growth rate out of anywhere in Australia at that point in time. And we knew why, which I'll get to in a minute, but we saw people jumping into that market because they wanted a piece of that action and that it was, for them, the holy grail of the growth train.
They don't want to miss the growth.
They don't want to miss the growth. But the reason it had the highest rate of growth in a short period of time was because of exactly what the example you gave. There was a big development of apartments that were sold with, I'm going to call it inflated prices, more than the market for a finance reason, perhaps I could say. But
it really between the lines in this one.
Yeah. That just clearly those settled sales just jumped the price. So the headline was fastest growing rate of growth, da-da-da-da. Literally 2 years later, the headlines were to the effect of the highest mortgagee in possession area in Australia. Same place. Yeah. But now if you were that person that just purely goes on data and chasing that without any relevance and truth, well, okay, why is the data telling me that? Now, I know a lot of people out there would be educated and sophisticated enough to see that, right? But equally, there's a lot of people that won't.
Yeah.
They won't see it. They won't understand it. They wouldn't even be a consideration. So this podcast, this topic or topics is for those people. Everybody else is above that. You may as well turn off and come back to the next one.
Yeah. So I guess the data does lead us somewhere though, right? So we also need to correlate that with jobs, the employment. But at the end of the day, you can have all of these fundamentals, right? Infrastructure, population growth, and all. If there isn't increasing employment or increasing salaries within that area, your growth is mediocre, right? You'll still have growth, but it'll be mediocre because there's no excess money coming into the area. Now, a really good example of this is if you look back to Perth, when they tried to restart the economy a few times once the resources boom had tanked. And they're throwing money after money on infrastructure. And if you recall, Steve, we went to Perth doing our on-ground research, and there were whole shopping centres, that massive shopping centres that just were basically empty, right? And you even almost got a haircut there because the barber was just sitting there, but then we decided to leave him alone because he was sleeping
in his chair, literally. But there are other shopping centres
that was vibrant, yes, in the same state.
Yeah, correct. So if we talk about the median, we talk about the average. So that's one piece of data that you shouldn't solely rely upon, and make sure that you understand the truth behind it. You mentioned jobs growth is extremely important because that translates into income into the localised community, sometimes from a broader point, the state, and that translates through to people's confidence increasing, therefore their risk profile increases. And I'm not talking about red or black at the casino, it's just what they're capable and comfortable in spending within the localised economy, environment. So jobs are absolutely essential. However, determining the difference between stable and transient jobs is
really important.
Very, very important. So, and what we mean by that is there are some tourist locations which have a transient workforce, but they also have a transient population. And it's very easy to see or to just take as gospel numbers. Jobs have increased, wages have increased, but it might be seasonal. And that doesn't necessarily mean a one-trick pony town out in the middle of nowhere picking oranges. It could be tourism-based. It could be mining-based.
Mining-based, yeah. There's a big article a couple of years back on people that had done the dough in a mining town in WA, Port Hedland, where the initial flurry of the rents absolutely going through the roof was all of these consultants and construction workers coming in to set up the mining operations. And when the business became, or the mine became largely automated, they then left because they were there to actually set it up. And people misinterpreted that as, okay, the mine's here, jobs are going crazy, the wages are crazy. So houses that were previously selling for $350 started selling for $1,050,000.
I remember that.
Yeah. And the rents were crazy as well. They're $2,000 a week. And overnight, the tap got turned off. And the people that had then bought these properties at, say, 700, 800 and saw their growth go all the way up to say 2 mil, couldn't sell them at 350 because there was no one to buy because there's no more money in that community.
Yeah. Ironically, those communities have bounced.
Yes,
But it sent a lot of people to the wall.
correct.
And you don't want to be a part of that. It's you don't want to be living on 2-minute noodles to support your property because that's not fun.
Yeah. I guess the first thing when you look at a property, the first thing you need to be looking at is that if it doesn't go my way, whether it is the property cycle, life itself, how can I sell this property and how easily can I sell this property without losing significant money?
So how liquid would the market be?
That's right.
Yeah. Now, there's different forms of liquidity within the market. Yeah. Clearly, coming back to the data, it might be days on market, stock on market, etc. Yeah, more stock on market, longer days on market. It's what it translates into. But there's always, I'll rephrase that. For the most, there's always a point where it becomes saleable. It's just that the more you go to the never in terms of location, the less liquid that market is. And when things are sideways on you, in terms of life and therefore the market, your potential buyer has shrunk to zip.
Yep.
But if you were in Metropolis, well, you've still got a pool of buyer there at a value proposition for whomever it may be. Because in those, I remember in those Port Hedland days, you could not give them away.
No.
Like literally could not give them away.
In fact, there were several exposés on ABC and even a current affair of people losing their dough. But you could see once the story unfolds, and I'm not belittling anyone here, but as the story unfolds, you could see the telltale signs there as it progressed. But maybe they're too far committed, or they were just simply blinded by their first win to then jump onto the next one and then the next one and then the next one.
So let's not debunk, that's not the right word. Let's challenge another data point around why it's so important as in an individual basis, and that is rental yields. Now, typically, yield is somewhat of a representation of supply and demand at that point in time, if we look at it as a top line figure. But there are many, many instances where that top line figure has been massively distorted one way or the other, up or down. So if we look at vacancy rates across Australia now, and just from the top of my head, you have, and correct me if I'm wrong, you've got Melbourne, and these are very general numbers, and that's my point. You have Melbourne sitting at around about 3.4. You've got Sydney, I think, about 2.7. You've got Brizzy at about 1.5, I believe. You've got Perth at around about 0.9. You've got Adelaide or South Australia around about 0.7. And the list goes on. So vacancy rates as a collective are getting tighter and tighter and tighter. Think back to my earlier commentary around APRA back then, and overlay COVID in some cases. But if they're top line numbers, you could dig deeper and find out the truth into different localities. Now, yes, there are some websites out there that give you a very broad view in a suburb scenario or a council orientated picture, but you want more than that. You actually, if you're investing in or potentially investing in Smithville, then you need to know what Smithville and the absolute localities right around it, the neighbouring suburbs, are. And
particularly the neck of woods you're buying, so the streets that you're buying, because it could be as different as street by street.
And there is no program, there is no website.
There is a program.
Yeah,
phone call.
Yeah, true. It's software.
That's it.
It's but there's no way you can plug in on the interweb to say, well, okay, what's the vacancy rate of Smithville? This is where you actually need to do a little bit of the hard yards yourself, and that is, as you say, pick up the phone, ring all the local agents, find out how big their rent roll or their rent, how many properties they manage, and how many are vacant, and just do a quick calculation with your phone if you're not maths and.
Yeah, and it's a skill to get that information off the agents.
Well, true, that's a good point. It is, because you could be, Mr. and Mrs. Nobody ringing up an extremely busy property manager without a relationship, saying, well, you don't know me, but how many properties do you manage? And are you going to give me the information? So clearly there's a bit of a script.
If I were the property manager, I'll give you the address of the nearest lake.
Well, I'd just tell you whatever you want to hear, probably, so I'm too busy. But so there is a bit of a script or process to create a relationship.
So what you're saying is this is not an overnight thing, right? You can't
It's
just jump on an area and expect to become an expert on it within 5 minutes.
Correct. Speaking of experts,
Soapbox?
No, it's not a soapbox moment, although it could be, but it won't be. I want to just go back to the property clocks, and I won't mention who they were. But prior to COVID, the property clock had, and I might have said this before, had indicated that the central coast of New South Wales was at its peak, or thereabouts. Side note: from 11 to 12, nobody know how long that takes.
Could be
1
1 week, could be
2
10
years.
years.
Yeah. But it was at the top of its cycle because of, well, nobody knows what the thought process is behind it in their particular case, other than some top line sort of statements. Yeah. Now, had you been an investor or an owner occupier or whatever it may be, that had thought and just read that and said, well, that's gold, that's real, that's enough information for me, and bypass the Central Coast, there are some instances where you've missed out on, I'm going to call it 100% growth, doubled in the last 3 to 4 years.
Yep.
Had you just looked at that data point,
just data in isolation,
without knowing what was behind it. Bringing that back into relevance around the point of vacancy rates. So you've got where they've thrown Sydney as a basket, or New South Wales as a basket case into the basket around the vacancy rates. Let me tell you that up on the Central Coast, it's almost a case where people are fighting each other to rent properties, and has been for 2 years, and not showing any signs in the in the near future of changing. And there are isolated suburbs and locations and LGAs throughout Australia that are doing that.
Yeah.
Conversely, there are areas throughout Australia where you can't rent a property.
No.
In other words, you can't give it away
because
of the circumstances we are today. So once again, the vacancy rate, while very, very important, you need a little bit of truth behind it. And what's the pipeline?
Exactly right.
Because the pipeline analysis will give you relevance to what the data is telling you at the moment around that vacancy rate.
Yeah, so it gives you a good indication as to how sustainable the rent that you're getting right now is. So is it just a flash in the pan, or is it going to be there for a few years before it may encounter some resistance in getting it rented out quickly because there's more supply coming to the market? So all of those things are important, and this is where constant review of your situation comes into play, because as your properties start becoming vacant, I'll give you an example. One of my clients emailed me, and this is a property that he is in Queensland, and he's just given his tenant a $50 increase to re-sign them into a lease. Now the tenants actually pushed back, and they pushed back and said, we're good tenants, and just because the market is where it is, word for word, because that's the email that was forwarded to me for some recommendations. Just because the market is where it is doesn't really give us comfort that our rent should go up by $50. How about we do $30? Or if you want $50, we'll only sign a 6-month lease. Now, this is where your logical approach needs to come in. So on this particular property, if the tenant did vacate, we would have to spend some money on it, right, to freshen it up, to get the same rent that we're trying to push right now. So one of the recommendations I said was, well, give them a longer lease, right? So that gives them surety. Or you may want to back down gracefully, and instead of $50, maybe talk anywhere between $30 to $40. You've got the best of both worlds. They're happy, you're happy. And a happy tenant tends to ignore your mundane repairs. They can put up with that, as opposed to an unhappy tenant that will want everything fixed because you push the rent up $50 a week.
Yeah, it's a good point. We're not for 1 minute not suggesting that you could be a slumlord at all, but there can be a difference between a want and a need.
That's
firstly.
right.
Secondly, it's not a them and us scenario. We've all been tenants at one stage or another, and I think a lot of people out there that aren't investors think that it is that them and us scenario.
The evil landlord.
Yeah, and it's the furthest thing from the truth. It's a commercial decision, but one done with
Yeah,
sort of
you can look
ethics.
at the holistic picture
Correct.
and with ethics. Yeah,
Yeah,
that's right.
Correct. There's also a lot of websites out there which I'd urge people to use as directional pieces only. And where I'm going to this with is around the narrative in the media at the moment, or from the banking around the DDI, so the debt to service, debt to income ratios, and other scores is what the websites refer to. We'll score this area. Once again, that's a collation of maybe algorithm-driven numbers, to form the data to give an opinion. And whilst I'm all about technology and AI and everything like that, property is not there yet. So to be making $500,000, $2 million decisions based on a spit out of a recommendation from a bit of AI and computers, I think that's a gamble. That's a speculative approach, because what technology can't in the initial stages take into account is the humanology of an area, of a house, the emotive piece
That's it.
to it.
Yeah. While you're talking, Steve, something popped into my mind. One of the things that, we rely on data heavily is valuations, right? And how much we want to pay for a property. And so let's say we had two properties side by side, both were 600 square meters. Both have got identical looking houses on it. The value, as far as data is concerned, the automated valuation, we likely pick it up as the same value, right? However, it doesn't take into account whether one's got really good side access, so you can actually put a granny flat at the back, or one's got a sewer line going across the backyard, so you can't develop it, right? Yet they both pick up as the same price. So this is where you're taking the data and then correlating it to the ground truth. In other words, what are the other metrics behind this that is not caught up by the data to then make a collective decision?
The truth is
The
exactly
the truth is out there.
Yeah, well, it is. But that's what it is, because once again, that's data being very, very, very misleading. So it could be about easements, could be about condition.
Yes.
Did it have an extension and add 3 bedrooms? There's so many different components rather than just the number in isolation. I guess. So now that we've talked about data, that it can be wrong, often it is. Even in isolation, or even broadly speaking, let's quickly talk about the future. And we may as well jump on the bandwagon with everybody else and talk about increasing interest rates. COVID's now gone. We have mobility, potential for the international borders being open with volume over a period of time. Where do you see the market going?
Well, that's an interesting question. The reason being that, first of all, no one can predict the future. But given what we've got on our vision board, or our crystal ball, with the bits and pieces thrown in, so immigration, finance, COVID's been handled, and the job scenario, inflation, all of that is as it should be. The markets do go up and down, right? So as people's sentiments change, the markets do go up and down. With the migration, I think we'll be looking at next level migration in terms of reasons why people would want to migrate in Australia. And this is sharing a personal experience. My daughter went to hospital last night, and she had an appendectomy, and as I was sitting in her wardroom, I reflected back to me as a migrant in Fiji. If the same scenario had unfolded, we are talking a 5-day saga. Here, because of our health system and because we're used to it, we tend to downgrade it or downplay it. But our health system is pretty good over here. So within 10 minutes of arriving into emergency, she was seen by the triage, and within 25 minutes she was in a ward, and the following morning she was operated on. Now, that's what as migrants people want to come into, and especially with COVID and how different countries have handled COVID, we're going to see a huge, a really good quality of migrants coming in with money and looking towards the future of their generations. So that's our X factor going into the next cycle. So there may be a slowdown with finance, a forced slowdown. However, the catalyst will still get added on with these people, these migrants coming in, most of them this time around with money. And they're going to jump into the bandwagon of property ownership. So what I'm trying to say is that who knows what the future is? Stick to the fundamentals and look at where it makes sense for you to buy, or in some cases, whether it makes sense for you to sit this one out.
Yeah, that's good advice. It's very good advice because everybody is unique in their own circumstances. I do tend to agree. I think lending is as good as it gets today.
Yeah.
If you're waiting for a better situation in terms of, generally speaking, across the board, you'll be waiting a long time. It's as good as it gets today, barring that we don't have another worldwide event, which looks like that won't be the case. So lending is good. While you can get it, you should get it. You don't have to spend it.
But, our advice throughout, even before the pandemic, has been always make your equity liquid as soon as you can, so that you've always got the cash the capital available.
Yeah, and in a minute we'll finish with some points. I think immigration is huge. It'll be a very, very, very big player, and there's probably 2 or 3 different scenarios that will play out. And to me, the most obvious one is, or the most probable one is more, once again, centered around lending as it always is. I think rates will go up somewhere in the next, call it 12 to 18 months.
I'd say 12 to 18 months is a safe bet. Yeah.
Yeah, not astronomically. We're not going to see 5% overnight. There's too much at play for that to happen. I think that there's potentially going to be, and I'm really sort of crystal ball gazing, there may be another APRA tap the brake. And that would probably be in and around, as I mentioned on our Facebook Live the last week. If I was the banking system, I'd be looking at LVR positions.
Yes.
That's the easiest way.
Squeeze back the 95s and 90s.
Yeah. And we've already seen ANZ came out, they dropped their variable last night at the time of this recording, increased the fixed. What that's doing is they drop the variable to the really good risk candidates.
Yes.
Sub 70% loan to value ratio, principal, place of residence, P&I. There goes your first homeowner.
Yep.
Straight out of the market. Like, they're not going to be able to do that. They're the ones at 90, 95, potentially speaking. So there'll be an inflection point there for the future, for sure. How that will play out, and once again, I'm trying to envision a path here, is that over the next few years, potentially, as lending does become harder, less people will be in the market, population will increase via immigration, and just naturally, that supply will be tighter. Rents will go up. Rents could go up in a fashion that we haven't seen for some time. Now, that won't be everybody, and that's a general statement, but there will be areas, I believe, that will happen in that way, shape or form. I also think that consumer confidence will inherently get better and better above where it is today, which is almost, I'm not going to call it record levels, but it's very, very strong. As we now have mobility, there's going to be a jobs shortage, skilled labour shortage. We'll have wage growth. There'll be the inflation. People will become more confident on spending, on whatever that looks like to them. The economy wheels spin, and you put all of this together with a few other components. And dare I say it, I think I did say it. I said it once we got out of the first lockdown. It could be the roaring 20s.
Yeah, absolutely it can be.
I know it's a big call. I think the world wants to rejoice.
You've got all hallmarks. You've got all hallmarks, yeah.
Yeah. Worst case scenario, it stays as it is. You get inflation, rates go up.
You'll still get growth.
You'll still get growth. You'll still get income growth. And I'll fix my rates for 5 years and I'll sleep easy.
Yep.
Lots of different components.
And then 5 years' time, Steve and I will be talking about, his 4.99% fixed rates, which is filthy about.
Yeah, well, not for much longer. It's I've only got a year to go on it, but I'm actually, as I said, I can't remember where I said it. It was on one of the things. I'm actually paying the break costs to do it. Why? Because it allows me to service way better.
Way better.
Because I dropped the rate by more than 2%.
Yeah.
So,
So that's a commercial decision you've made.
it's a commercial decision, and not everybody should go out and run out to do that. But for me, it makes sense. So let's leave everybody with some really good tips that run true in any cycle, but probably more so today with that dynamic situation that we have because of all the obvious reasons and beyond. And my first tip for everybody is be liquid.
Yeah.
Now's your time with some recent growth that you may have had to be drawing down on that equity, being quite general, and parking it in the offset as long as you are disciplined.
Absolutely. Yeah.
Be liquid.
Yep. And so just to expand on that, being liquid means to get your property revalued and extract the allowable LVR back out onto an offset account. Now, my suggestion, and this is my tip, is that you don't leave your run till too late. As we are getting into the silly season, the banks generally have an embargo on refinances because they then give the purchasers priority over refinances. So if you're wanting to get the money in your accounts before Christmas, you need to start your run early. And if you don't know how to get started, or you wanted to have a conversation with a finance expert, just reach back out to us. We'll put you in touch with Z Shua and his team at MLS Finance, and they can assess and give you a clear pathway as to how to do that.
Correct. Now, just to repeat, we're not saying the world is on fire. We're just saying be prepared.
Yes.
And this is general advice, and it won't suit everybody to do so. But for those that can, they should, and get that ball rolling. What's the second tip, Vic?
Look, the second tip is stay between the flags unless you are a very, very, very strong swimmer or surfer and you've got heaps of experience behind you. And always protect what you already have before venturing out further. And don't speculate and don't try the new shiny thing just because the property cycle's where it is.
Yep, it's a good one. Third one for me would be, if you are entertaining to either enter the market for a first time or re-enter the market for the 31st time, whatever it may be, is to start that ball rolling now.
Yes.
Even though it might be a new year purchase, and that could be Jan, Feb, March, you really do want to be ahead of the curve. My guess is that the holiday season, Christmas, where traditionally before the last 4 years it was a great time to purchase, then for the last 4 years it's been a horrible time to purchase because everybody's trying to purchase because they think it's a great time to purchase, if that makes sense. I'm 50-50 on where it'll go.
Yeah.
This year, I think people are fatigued between their ears, and they just want to break. They can travel internationally, hopefully interstate, and I think people just want to get away and switch off.
Yeah.
Could be one direction, or the other scenario, everybody might go. The show goes on. Let's go, whatever that is to them. So it'll be interesting to see which way it goes. One thing that will be true to form is that finance will be just as hard to get in terms of the length of time.
Yeah.
So start having those conversations with your banker, broker, financier, whatever it may be, to be prepared so that you can hit the ground running early on the next year, because it is only just around the corner.
Yeah, it is. It is, absolutely. At the time of recording, it's only 6.5 weeks away from Christmas.
It's a bit scary, really.
Yeah, it is really.
So what's the fourth tip?
Look, the fourth tip is making sure that whilst the finance landscape is changing, talk to your broker, and if you've got any constructions parked, and especially when you're going to re-look at things over Christmas in terms of employment, in terms of your mode of income generation, maybe time to pull the trigger on it and not have it parked in perpetuity.
So if you're part of the great worldwide resignation scenario and you still want to invest, maybe get the sequence right.
Yeah, get the sequence right.
Resign, but
get the finance in place first.
Finance.
Yeah. That's not a pre-approval. I'm talking about restructuring and perhaps extracting enough cash so that you could actually do the construction cash and then recapitalize, assuming you can find the right lenders to help you pull that money out.
And the fifth tip for me, and probably the final one for me, would be stay the course. And that means stay the course before what you were thinking about before COVID in terms of growth patterns, goals to some degree, the trajectory, the sequence. Don't let COVID and what's happened over the last 2 years or 18 months thereabouts in terms of this massive escalated growth pattern that we've seen. Don't let it make you think that that's normal.
Yep.
Because it's not. So retune yourself if you think it is.
Absolutely.
And what's the last one from you?
Look, the last one, I was actually going to say stay the course anyway, so you've stolen my thunder in that sense. So I'm going to re-tack that and say, as you get into the new year, start looking at your rentals, start looking at how you can increase your income, and also, equally importantly, decrease your expenditure within the portfolio. So do a house check in terms of where your numbers are, so that when you're going into the new year, you're going in knowing your numbers and knowing what action plan you've got for each property, so that it then helps you set up and decide whether you are bringing forward your purchases next year, or are you pushing it back, or waiting for the right opportunity to come by.
So really you're protecting your
Protect what you've already got.
And if you're moving forward, protect your borrowing capacity.
Yes.
So don't roll into Christmas and load the cards up. It, in fact, in a perfect world, you shouldn't have any credit cards, because that, as we know, and as you've heard Z talk about before, kills your borrowing capacity.
Exactly.
And if you want a new car, it's 3 years or 2 year wait, depending on what it is. It's crazy. So delayed gratification.
That's it.
Well, there it is, folks. It's first one back in 5 months, recorded.
Bit rusty?
Yeah, but bit fun too as well. And what we were saying earlier on about we were just going to call it wing it and see what happens.
Yep.
Well, basically we did that. So stay between the flags, and of course the data does lie from time to time. So we hope you enjoyed it. If you've got any questions for us, just reach out on the socials, via the website, whatever it may be, and we'd love to have a chat. And if we could help you, even if it's just to give you some direction. Keep the questions coming, because we do eventually get to them on our Facebook Lives, which is where we tend to answer all the questions. And of course, it'd mean a lot for us if you give us a review, because a lot of work goes in behind the scenes, not necessarily from Vic and I, but from everybody else. And it means a lot to them. So we will see you next time.
One.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.